Okay, welcome to the deep dive. This is where we take your sources, all those articles, financials, analyst reports, even the forum buzz, and really dig in to find the essential knowledge.
We cut through the noise for you,
Yeah.
basically, helping you get informed faster.
And today our focus is Skeena Resources Limited, that's SKE, on the exchanges. You sent us a whole pile of information because you're looking at this precious metals developer, their SK Creek project specifically.
Hmm.
And you've seen the stock price. It's had a really significant run. So the core question you're asking is Skeena still a compelling buy right now near these highs?
Or is it maybe smarter to, wait, see if there's a pullback? It's a really common question when a stock moves like this.
Exactly. So our mission today is to unpack everything you shared. We want to understand who Skeena is, what SK Creek is all about, how they plan to build it, pay for it.
What's on the horizon, the catalysts, the risks, and crucially, what the sources tell us about the investment case today.
Right. Let's get into it. So who is Skeena Gold plus Silver?
Well, the key thing the sources stress is that they're a developer. They aren't actually mining and selling metal yet. Their main game is advancing the Skeena Creek Gold Silver project.
And that's up in BC's Golden Triangle, right? A pretty famous area for mining.
Very famous. And SK Creek itself isn't new ground. It was a mine before, operated from 95 to 2008.
And it wasn't just any mine. The sources mention it was considered the world's highest grade gold operation back then.
Yeah, the historical numbers are kind of mind-blowing. 3.3 million ounces of gold, 162 million ounces of silver.
Wow.
And the grades. Average 45 grams per ton gold, over 2,000 grams per ton silver. Just incredible stuff.
You really don't see grids like that often. But Skeena's plan is different now, isn't it? They're not going underground again.
No, exactly. Their goal is to remake this as an open pit mine. The aim is for it to be, again, very high grade for an open pit and also one of the lowest cost open pit precious metals mines globally.
So a completely different mining method, scale, everything.
Yeah.
Let's dig into the project itself then. SK Creek, still in development.
Correct. Development stage. Commercial production isn't expected until early 2027. Still a ways off.
And they've been working through the usual studies, PEA, PFS, feasibility. The sources you sent seem to really focus on the latest one.
Yes, the updated definitive feasibility study, the DFS, from December 2023. That's the cornerstone document right now.
And it lays out the economics. What do those numbers look like? Using, what, $1,800 gold and $23 silver?
That's the base case, yeah. And the numbers are pretty eye-catching. The after-tax net present value, or NPV, at a 5% discount rate, see $2.0 billion.
$2 billion. That's substantial for a project not yet built.
It is. And the after-tax internal rate of return, the IRR, is pegged at 43%. The sources definitely flag that as industry-leading.
Okay, 43% IRR. And the payback. How quickly do they expect to recoup the building costs?
Just 1.2 years after tax on that initial pre-production capital. Very quick.
And the costs once it's running, all in sustaining costs, the AISC.
Projected at US $684 per ounce of gold equivalent sold. Again, the sources highlight this as potentially being in the lowest cost tier globally.
So on paper, the potential looks huge.
Huh.
What are the actual reserves supporting this? How much gold and silver are we talking about?
The DFS defines proven and probable open pit reserves. It's almost 40 million tons of ore,
Containing.
containing 3 million ounces of gold and 88 million ounces of silver. That totals up to about 4.6 million ounces on a gold equivalent basis.
Okay. And how much would they be producing each year?
The plan shows the first 5 years being particularly strong. Average annual production of 455,000 gold equivalent ounces.
And the grade in those early years?
Pretty high for an open pit,
Yeah.
5.5 grams per ton gold equivalent. Over the first 10 years, it averages out to 370,000 ounces a year at 4.2 grams per ton gold equivalent.
High grades, strong production profile. Does that translate into significant cash flow projections?
It does, according to the study. Average annual after-tax free cash flow in those first 5 years is projected at $474 million
Wow.
and $365 million average over the first 10 years. So yes, robust cash flow potential.
Okay, sounds great, but you have to build it first. What's the price tag for construction, the pre-production capex?
Estimated at $713 million.
And how does that stack up against the potential value, the NPV?
The sources point out the ratio is quite compelling, about 8 to 1 after-tax NPV to capex. But it's important to note that $713 million figure is higher than in earlier studies.
Right, so costs went up. Why? What drove that increase?
It seems like a few things. They needed to add a water treatment plant that was about $31 million. They decided to build the permanent camp earlier, adding $21 million.
Okay.
Camp operations, travel costs, another C $15 million. Redesigning the mill building added about C $9 million, likely for snow load and efficiency. And then roughly $45 million in other cost owners team, sustainability initiatives, that sort of thing.
So a mix of necessary additions, bringing things forward for de-risking, and some general cost inflation, sounds like.
Pretty much sums it up, yeah. Standard stuff for big projects moving towards reality.
Let's talk processing. How are they getting the gold and silver out? Any changes there?
Yes. The 2023 DFS actually simplified the flow sheet. A really key focus was optimizing the metallurgy to create a much higher grade concentrate.
How high grade? And how do they achieve that?
They're targeting a super fine grind of the ore, down to about 10 micrometers.
10 micrometers. That's like dust. Incredibly fine. Why does that matter so much?
Because grinding at that fine helps liberate more of the precious metals. This lets them produce a concentrate that's packed with gold and silver. And the knock-on effect is huge.
How so?
Lower treatment charges from smelters, lower transportation costs because you're shipping less bulk. The sources estimate this saves around $400 million pre-tax over the mine's life.
Just from grinding finer and getting a better concentrate?
Basically, yes. Plus, that higher grade might mean they get paid for some base metals, lead, zinc, antimony that could have been penalties otherwise.
Interesting. A technical detail with big financial implications. What about recoveries? How much metal did they get out?
Gold recovery is projected around 83%. Silver recovery actually improved in this latest study, up to 91%.
And the plant size?
Starts at 3 million tons per year, ramping up to 3.5 million tons in year 5.
What about waste? Tailings, rock. How's that being managed? Especially considering the past mine.
They're separating rock that won't generate acid that goes into a standard storage facility. The rock that could potentially generate acid, plus the finely ground tailings that gets stored underwater.
Underwater? Why?
It's stored in the existing permitted tailings storage facility, or TSS. Keeping it submerged prevents oxygen from reacting with the material and generating acid or leaching metals. It's a proven environmental control method.
And site water. Runoff.
That gets collected and treated in that new water treatment plant before being discharged.
Got it. Okay, beyond the technicals, we know relationships are key, especially with indigenous communities. How is Skeena doing there?
This is critical. And the sources suggest Skeena has put a lot of effort here. The project is on Tahltan Nation unceded territory and asserted Setsalski Kaunlaks Hop territory.
And their relationship with the Tahltan?
It seems strong. They have formal agreements, ongoing negotiations for an impact benefit agreement, and importantly, they signed a consent-based decision-making agreement back in June 2022.
Consent-based? Implementing UNDRIP principles. That sounds significant.
It is. The sources highlight it as a first-of-its-kind agreement with the Tahltan. They're also engaging with the Setsatsky Kanemlaks Ha and other nations like the Niska and Gitano, whose territories the transport route crosses.
And broader ESG, environment, social governance.
They seem to be formalizing things. Mission, vision, values, board policies. They're publishing ESG and sustainability reports. They've hired governance consultants and recently appointed VPs for environment and social affairs and health and safety.
So bolstering the team as they approach construction makes sense. Now, the big one, money. That $713 million build cost. How are they funding it?
This was a major milestone highlighted in the sources. In June 2024, they secured a big financing package, US $750 million from Orion Resource Partners.
750 million US. Is that expected to cover everything?
The intention is that this package funds development and construction right through to commercial production.
Okay, what's in the package? Is it all debt?
No, it's a mix. There were private placements, so some equity. Then there's a US $200 million gold stream deposit.
A stream. So selling future gold production up front for cash now.
Essentially, yes. They've already received the first couple of payments on that $5 million in July 24, $45 million in December 24. More draws are scheduled through 2025 and early 26.
What else?
There's also a US $350 million senior secured term loan facility. As of the end of March 2025, they hadn't drawn on that loan yet. And there's an option for Orion to provide another US $25 to $100 million if needed.
Okay, so a comprehensive package. But you said the intention is it covers everything. Is there a catch?
Well, the sources make a point of saying that accessing those future draws, both on the stream and the loan, is dependent on Skeena meeting certain conditions.
Ah, so it's not guaranteed money?
Exactly. There's a risk noted that if those conditions aren't met, the financing could be insufficient or delayed. They might need to find more money elsewhere. That's a key risk for investors to track.
Definitely. What did their cash position look like recently? Say, end of Q1 2025.
As of March 31st, 2025, they had about $98 million in cash and equivalents, plus another $12 million in marketable securities. Total liquid assets around $110 million. Accounts payable were down significantly to about $19 million.
I saw mention of a derivative liability related to that gold stream. What's that about?
Yeah, it's complex accounting. Basically, it represents the value of the stream agreement on their books. It changes based on things like the gold price and credit
And
spreads.
it impacts their reported earnings.
Big time. In Q1 2025, the change in its value resulted in a non-cash gain of over $30 million. This made the reported net loss for the quarter, which was $38 million, look smaller than the actual cash outflow.
Okay, so you have to look past that accounting noise to see the real cash burn rate as they spend on development.
Precisely. Exploration spending, for example, was way down in Q1 25 compared to Q1 24 because the focus is shifting to building the mine.
And managing liquidity going forward really hinges on executing the plan and hitting those financing conditions.
That's the core of it. They have contractual commitments, about $46 million, due within a year as of March 31st. So managing cash flow is critical.
How many shares are out there?
Over 114 million outstanding as of March 31st, 2025. And they do use share-based payments as part of compensation.
Okay, so financing is largely arranged but conditional. What's the focus for the next, say, 24 months leading up to that early 2027 production target?
It's all about execution now. Detailed engineering is happening. They're ordering the big, long lead items, mills, transformers, things that take time, and they're starting to install the permanent camp on site.
And the crucial permitting step.
Very much in focus. The environmental assessment application and the major mines permit application are submitted. The company's forward-looking statements mention an anticipation of receiving the EA certificate in Q4 2025.
Anticipation. So, a target, not a guarantee. Permitting can always have surprises.
Always. Though the sources did mention a positive court decision related to Skeena back in April 2025, which might be helpful context.
Any other milestones? Financing draws?
Yes, those scheduled gold stream draws continue through 2025 and into early 26, providing cash injections. And they're apparently exploring refinancing options for the future, maybe to get better terms down the line. That could be a catalyst.
Beyond just building what's in the DFS, are they looking at ways to, sweeten the pot, add more value?
Absolutely. This is where it gets potentially very exciting. They're still fine-tuning the metallurgy, and they completed an initial study on potentially incorporating the nearby SNP deposit.
SNP, another high-grade past producer, wasn't it?
Exactly.
Yeah.
The idea is, could ore from SNP be processed at SK Creek? Could it extend the mine life from the current 12 years, maybe out to 15 or 16? They're also looking at repurposing the Albino Lake facility, which apparently holds some contained gold too.
And those base metals, lead, zinc, antimony, are they firming up plans for those?
They're actively investigating it. The potential value mentioned in the sources is pretty staggering, like potentially $1.2 billion from antimony, another $1 billion from lead zinc over the mine life.
Wait, over $2 billion additional potential revenue on top of the gold and silver in the main DFS?
That seems to be the implication if they can successfully recover and sell those metals. It's not fully baked into those base DFS numbers we talked about earlier. They're even planning for a possible pressure oxidation plant later on, which could boost overall metal recovery another 10–15%. Huge potential upside there.
Wow. Okay. Any other optimizations?
They also did work on potentially steepening the pit walls. If they can do that safely, it means less waste rock to move, or potentially accessing more ore, both good for economics.
And we mentioned the new management hires strengthening the team for the build.
Right. VP of Environment, VP of Health and Safety. Looks like building out the team needed for this next phase.
Okay. Project looks strong, financing largely in place, potential upside being explored. Let's bring it back to the market and your question. The stock's run up a lot. What's the current view?
Yeah, performance has been strong, up 264% since mid-2020, according to the sources. Recently hit a 52-week high of C$18.64 and trading right around there, closing near C$18.57 in the data provided.
It's well above its moving averages.
Clearly, above the 50-day and 200-day, signaling strong bullish momentum.
What do the analysts think? What are the price targets?
The average or consensus 12-month target is about C$18.04. So pretty much right where it's trading now.
Okay. But what about the range? Is there a high target?
Yes. The high target cited is C$21. From current levels, that suggests maybe 13% upside potential to that highest analyst forecast. Raymond James was noted as having recently raised their target to that C$21 mark.
So analysts are generally positive, but maybe see limited near-term upside on average. What about technical analysis? Charts, trends? Does that help with the buy now or wait question?
The overall technical picture is definitely bullish. Strong uptrend, positive signals from moving averages. Technical suggest the upward move could continue over the next few months.
But it's near that peak, that 52-week high. Does that create caution?
It does. And this directly addresses your dilemma. The sources note that while the trend is strong, being near the top of the trend channel and recent highs, well, that may normally pose a very good selling opportunity for the short-term trader.
Meaning a pullback is possible, even likely from these levels.
It suggests a reaction back towards the lower part of the trend can be expected. So yes, a pullback is definitely a possibility according to the technicals.
So for someone looking for maybe a less risky entry point, what do the technicals suggest? Where might support be found?
The analysis points to a support range between roughly $50.85 and $17.35. Immediate support is seen around $16.85, and the short-term moving averages offer support closer to $17.35.
Okay, so buying right now around $18.50 is an option. The trend is up, but you risk catching a short-term dip. Waiting for a pullback to the C16.85, C17.35 zone might be lower risk.
That's the interpretation given in the sources, yes.
Yeah.
Aggressive entry now is possible, but comes with that volatility risk.
Right.
They even suggest a potential stop loss around C18 if entering near current highs.
Interesting. One last thing. Is there potential for the market to fundamentally revalue Skeena higher as they hit milestones, a re-rating?
That's a really key point for a developer like Skeena.
Hmm.
As they move from studies to construction, as they get that key EA permit forecast for Q4 2025, as they physically build the mine and de-risk the project step by step towards 2027 production.
The market perception of risk changes.
Exactly. The market might assign a higher valuation multiple as execution risk decreases. Moving from developer risk to construction risk to producer risk usually comes with a re-rating. And if they deliver on those big potential enhancements, SNP, Albino Lake, the base metals, higher recoveries, they could absolutely drive a significant re-rating beyond just the base DFS case.
Okay, so let's try and synthesize this, pulling it all together from the sources.
Skeena has outlined a potentially world-class project at Eskay Creek based on that 2023 DFS. High grades, low costs, rapid payback. The numbers look great on paper.
And they've secured a major financing package, US $750 million. That's intended to get them through construction, although accessing all of it depends on meeting certain conditions.
Right. And they're actively working on de-risking detailed engineering, permitting is underway, and they're exploring these really significant value-add opportunities like SNP and the base metals.
But it's still a developer. Construction carries risks, permitting isn't guaranteed on their timeline, and financing has conditions. And the market has recognized a lot of this potential already, driving the stock price up significantly.
Which brings us right back to your core question. You're weighing this compelling project, the de-risking steps ahead, against a stock price near 52-week highs, where technicals suggest a pullback is quite possible in the near term.
So the big question left for you, the listener, to ponder is, how much of Eskay Creek's potential, including those possible enhancements, is already baked into today's stock price? And, given the technical setup, what's your personal risk tolerance for buying near these highs versus potentially waiting for that dip towards the support levels the sources identified?
We've taken that deep dive into Skeena resources. For you, the project, the money, the plans, the market signals, all based on the materials you provided.
Hopefully, this breakdown gives you a much clearer view of the potential rewards and the inherent risks facing Skeena right now and helps you frame your own decision-making process regarding the stock.
Consider this a starting point for your own continued research and due diligence.
And please remember, this discussion is purely for informational purposes. We've explored the information in the sources you sent us. This is absolutely not investment advice. You should always consult with a qualified financial advisor before making any investment decisions.